webinar that will be taking a foray outside of admissions and into financial aid. So we're very fortunate today to have Stephen Brown with us. He's the Assistant Dean of Enrollment at Fordham Law School, and I'll introduce you to him in just a moment. But I really appreciate you coming out to our webinar. We offer these on a regular basis, and we have a number coming up as well. So if you pay attention to your email from NAGAP, we will be publicizing a number of webinars coming up in June from our chapters in New England and Texas, and also we have a salary survey update from our research committee coming up on July 12th. So keep an eye out for those. We'll also have another one with direct development in July with a follow-up to our conference. So definitely check those out, and thanks so much for joining us. This is part of a new initiative for us in getting webinars going, and so far we've been very pleased with the turnout for these and hope you get some great information. So today's session is on financial aid. As I mentioned, it's about understanding new loan options for careers in public service. And as I mentioned, we're joined today by Stephen Brown, Assistant Dean of Enrollment at Fordham Law. He's a financial aid person at heart, and he oversees JD admissions and financial aid and delights in introducing complex topics in an easily understandable way. And Stephen is formerly the Director of Planning, Research, and Student Finance at NYU Law and had a career in mental health before working in law school administration. He is a frequent conference presenter and presents regularly not only to his students, but also to the public, deans, pre-professional advisors, and colleagues. His specialties include loan forgiveness and the Loan Repayment Assistant Program, strategic financial planning, financial literacy, compliance, and the federal role, and the basics of financial aid. He received his BS and M.S.Ed from Fordham University and an Ed.M from Teachers College at Columbia. He plans to complete his dissertation at NYU on the impact of loan repayment assistant programs on lawyers' plans and careers. So without any further ado, I pass it along to Stephen. Thanks so much for joining us today, and we look forward to the session.
Thank you. During the session, you're all muted, so it's difficult to have a conversation, but we do encourage you strongly to use the question function should be on the right-hand side of your screen to ask questions. I will reserve the right to hold off for a little bit in case the answers are coming up later. But as I'm saying things, if they're different from what you understand, what you've heard, what you've experienced, or as has happened before, you're also a student who's in repayment and can bring in some real-life experiences to this, that's wonderful as well. I am here, I'm Assistant Dean at Fordham. Financial aid is a big part of what I do. I've been doing these presentations actually since 2007, since the federal government has started the Federal Public Service Loan Forgiveness Program. So we'll have some fun with this, I hope. So who cares? Why are you all 63 of us admissions folks listening to a presentation on loan repayment? That's a financial aid-y thing, isn't it? Well, it is, but it's also really important for us, in our work in admissions, and for us as we're recruiting students, talking about the programs we offer and how that fits with students, and knowing enough because these programs really can allow for a career in public service. Prior to 2007, students were borrowing and still borrowing a lot of money, although in 2006, the Grad Plus program was created and allowed graduate students to borrow almost obscene amounts of money. But these programs, prior to 2006, if you borrowed $50,000, $60,000, $70,000, you really didn't have the ability to repay loans. That has changed rather dramatically. So what do we want to do? We want to understand the concepts. I want to understand partial economic hardship, understand IBR and pay as you earn, and it's a good reason to question or interrupt as I start moving into financial ease. IBR is Income Based Repayment. We'll deal through some of that, and pay as you earn. The good, bad, and ugly. It's an amazing program, but also maybe not. How does it relate to your students? What are your students experiencing, borrowing, looking at over a career path? So once you understand partial economic hardship, then it's easier to understand IBR and pay-as-you-earn. And once you understand IBR and pay-as-you-earn, then we can move to public service loan forgiveness for federal loans, because that becomes very important, and that's kind of a big theme here. And the overall goal is so that you're effective with your applicants, with your students, you're comfortable with them, you've heard about this. I've done several presentations where admissions folks and even financial aid people had not heard about the program. Students and prospective students were asking, and the response was, oh, I've heard something. This is a problem the administration has with the Secretary of Education. They have lots of good information on the program, but people still aren't paying too much attention to it. So we'll see as we go. A little bit of background, 2007. Congress passed the College Cost Reduction and Access Act, created the income-based repayment option that was effective 2 years later, and it defined the concept of partial economic hardship. And 2007 Act created the Public Service Loan Forgiveness Program. And again, it's for federal loans, and it's for borrowers who are working in public interest and public service. We will talk some more about that. Actually, we'll talk a lot more about that. It was effective October 1st, 2007. It's forgiveness after 10 years. So the first forgiveness we'll see will be November of 2017. This is a major change, and this is a kind of financial aid thing. But up until this year, and students have been now in the program for 6 years or 5 or 6 years. Up until this year, the income-based repayment program was not in the master promissory note. It was not a contractual agreement between the borrower and the government. And that has raised some real issues of concern. Will this be in existence for me 10 years from now? What happens when the first forgiveness is a brain surgeon or a lawyer or somebody who has borrowed lots of money and is having a great deal forgiven? What happens there? How does that impact things? Kind of what's going on. So now it's built into the promissory note. You don't have to read this. And the public service loan forgiveness is built into the promissory note. So this is a very good thing for students and student borrowers, so they can see that they have real chances for forgiveness of these loans. All right. Last year there's some changes, and this is the pay-as-you-earn program. In 2011, President Obama introduced the Income Contingent Repayment Program, later renamed Pay-as-you-earn. It was announced in October 2011 at a speech at the University of Colorado, subject to negotiated rulemaking. So the details of it had to be worked out between the Department of Education and these federal negotiators, who are people from the community, from the education community, finance community. And the President had the ability to do this because the Income Contingent Repayment Program was not statutory, as is most of the rest of the Higher Education Act, but that this was a program set up for governance by the Secretary of Education. It was effective December 23rd, 2012, not subject to the master calendar for whatever reasons, but became effective 2 days before Christmas. Students were in finals. Schools were getting set to close, or indeed were closed in many cases over a break, so there was not a lot of attention paid to it. Finally, kind of the other election year change, the subsidy on the subsidized direct loans was removed effective July 1st, 2012. And there was not a hue and cry from students that this is a problem. And it kind of snuck by. And indeed, this removal of the subsidy is to the tune of $3.5 billion or so, and that's going to subsidize Pell Grants for undergrads. All right, let's figure this out. No, calculators aren't necessary, but it always freaks people out a bit, so I put the slide in. In the grand scheme of things, undergrads can borrow a total of $88,000 in federal loans. Graduate and professional students can borrow $138,000 in the direct loans, plus the Grad Plus program. And the Grad Plus program is a loan that graduate and professional students can borrow on their own signature, provided they have an absence of bad credit, and they can borrow up to cost of attendance less other aid. So if your school's cost of attendance is $70,000, it can be an expensive law school, perhaps. Tuition is $45,000, living expenses $25,000. Student can borrow $210,000 for 3 years of law school. The numbers on the bottom just are monthly payments at $31,357 a month. At $57,662 would be a standard payment. And of course, graduate and professional students are priceless to borrow from commercial. This is something we give out to students and something you can calculate or ask your financial aid folks to calculate or your finance people. It's not all that difficult. We give out to students an estimated net income table. And you see this one starting at $50,000, or it's kind of geared to our law students, to give them a sense as to what they're actually living on, what they take home at the end of the month. About half of our students have substantial work experience, 2 or more years, so maybe not substantial, but have work experience before law school. 40% do not. They are always surprised at that first paycheck. It doesn't quite look like their gross figures. All right, economic hardship, the kind of core of all of this. And I read from the slide. I tend not to do that. But the borrower is experiencing partial economic hardship when the loan payments on a standard 10-year amortization exceed 15% of the borrower's income above 150% of the poverty level. For pay-as-you-earn, it is when loan payments on a 10-year amortization exceed 10% of the income above 150% of the poverty level. And a borrower experiencing partial economic hardship may elect to pay under IBR or pay-as-you-earn if the student is eligible. What does this mean for the rest of us who don't have the calculations? For family size of 1, single new graduate or single borrower, $11,490, $11,500 is the poverty level for a family size of 1. We did the math for you. 150% of that is $17,235. So if the borrower is earning less than $17,235, they are not required to make any payments on their federal student loan, their eligible federal student loans, and we'll get into that in a little bit. If they're earning $17,236, they pay either 15% or $1.50 or $1 toward their education loans. You'll see this slide again because this is pretty significant. Here are the calculations as to monthly payments. And this is often when questions come up, this is when people gasp if we were in a room together. If you are earning $30,000 a year, regardless of the amount the borrower borrowed in student loans, so they could have $200,000 worth of debt, $300,000 worth of debt, their monthly payment under IBR is $160 if they're earning $30,000 a year. Even better, in pay-as-you-earn, the monthly payment is $106. When we first did these calculations back in 2007, and the formula was the same, but the poverty levels were different. And the first reaction, there were 3 of us sitting in a room, in a conference room in Washington, getting set to do this presentation as the law was being signed. We calculated and recalculated and calculated, a second time and 5th time, because this is amazing. Even at $60,000 under IBR, the monthly payment $535. Under the new pay-as-you-earn, $356. If we go back 3 slides, so at $50,000, you're bringing home about $3,000 a month. Your payment would be $273 on all of your federal student loans. you'll see this chart again as well. This is just looking at larger families because it's based on family size. The number in the family impacts the poverty level. So, you see at $30,000, if you have a family size of 4, you're not making any payments. Again, we'll go into details on this. This is to get your attention. This is an interesting, another set of calculations. Remember, there's financial aid in me. Another set of calculations, just to give people a sense, at the various income levels, from 30 to 110, what the minimum amount of loans would have to be eligible for a partial financial hardship. So if you borrowed less, a $30,000 income, if you borrowed less than $13,866, then you are not eligible to make payments under IBR. If you borrowed anything more than $13,000, you are eligible to make payments. So you see under the pay-as-you-earn, even at a $30,000 income level, $9,000 in loans is still eligible. Average indebtedness for undergrads coming out is still just about $18,300 or so. For graduate students, it really depends on discipline. Amazing stuff, amazing calculations. Scary, generous. Could this be true? Are they pulling our legs? Will this be here? Kind of the questions that we're hearing from students frequently. Now that we've got all of that out of the way, now let's look at some of the details. Any questions? I'll take a quick pause before we go into the details. Any questions? All right, moving right along. So feds are now calling this effective in December. They're calling IBR and pay-as-you-earn income-driven federal repayments. One of the sessions I've done on this has been income-driven federal repayment, driver's education. So that's what we're doing here, giving you some power on the driving side. Income-based repayment, pay-as-you-earn are formulas you've been through, we'll go through again. They are only applicable to federal student loans. They have to be FFELP loans. FFELP loans were federally guaranteed loans that were issued through private banks. That ended in 2010. Direct loan, we all moved to direct loans at that time. So those count, FFELP or direct loans for income-based repayment only. For pay-as-you-earn, IBR, FFELP, or direct loans. For IBR, direct loans, Stafford loans, the name Grad Plus, federal consolidation loans. Parent Plus doesn't count, or consolidation with parent loans doesn't count. And again, the borrower has to be experiencing a partial economic hardship. For pay-as-you-earn, only direct loans count. So if a student, and we see this a lot in the graduate world, a student had undergraduate loans, and prior to 2010, those loans do not count as they are, but they can be consolidated, they can be combined with other federal student loans for a new loan. For pay-as-you-earn, the borrower has to be a new borrower as of October 1st, 2007. What does this mean? So part of the reason behind the new borrower is that this starts to get expensive very quickly. And since the promise was to students who were in college in 2011, the department came back and said, okay, everyone who does not have a loan and no outstanding balance on a FFELP or direct loan prior to October 1st, 2007, or no balance on the loan when a student received a new loan after October 1st, 2007, they can be eligible. So if a student has a direct loan or a FFELP loan from 2005 or 2006, they are not eligible for pay-as-you-earn. They are eligible for IBR, but not pay-as-you-earn. An exception to that would be if the loans were even older and paid off sometime after October 2007, but before the borrower borrowed new loans, then that would count as well. Borrower has to have received disbursement after October 1st, 2011, and that can be a direct loan or a direct consolidation loan. A question came in about the slides. Marcus, how are we handling the slides? This will be posted on the NAGAP website?
Yeah, there's been a lot of questions about the slides, so if you're willing to give us the PowerPoint, we'll send that out to all attendees, and we also are recording the whole video of the entire webinar, and that'll be posted on our YouTube channel either later this afternoon or first thing in the morning, but we will notify all the attendees and those who couldn't make it, of course.
Oh, cool. Okay. So that's good, and now a full screen of questions came up. I had not seen them before. Okay. So if a loan was taken out on September 2007, Nancy's asking, is the Department of Education flexible? No. If the loan was taken out prior to October 1st, 2007, that's what counts. From a student conversation side, that becomes a very difficult conversation to have with students. Well, if I knew this, I would have paid it off. I wouldn't have borrowed. I have a student who has a $500 loan that he took out in September 2007, did not pay off before. I actually got into repayment, was in repayment for a year, but didn't pay enough to have that loan paid off. Then went to graduate school in 2012, last year, before he came to law school. He is not eligible for pay-as-you-earn, however, is eligible for IBR. Okay, moving along. And again, direct loans, direct loans, direct loans. So students have the ability to consolidate. They can talk to financial aid about that. That's not stuff we need to know on the admission side, just knowing it's available. Okay, and we remind students and graduates that they have to apply annually for income-based repayment. The feds check your income every year just to make sure that they're not perhaps misrepresenting, underrepresenting income. It's all online now at studentloans.gov. If you haven't had a chance in your spare time to take a look at studentloans.gov, it is a very very useful, good, well-organized website, very impressive, coming out of the Department of Education. Students have to affirm that the information is correct. There were some issues in the first years of doing this where they would do an IRS match, and the student was a student, a full-time student, the year before the year he or she graduated, and had little or no income. Were they being able to get away with no $0 payments? Were they underpaying, things like that? So effective November of last year, there's now a statement that the information is accurately describing what the borrower's real income is. And if things have gone the other way, that borrower income has decreased for whatever reason, then the borrower can fill out a separate paper application to confirm that. So it's designed to be flexible and to discourage cheating. You've seen this slide before. Just a reminder of partial economic hardship, 10%. If loan payments are 10% of the income above 150% for pay-as-you-earn, 15% for income-based repayment. You can skip this slide. You can skip this slide that just says what payments are and where to find them and things like that. Another plus that people don't talk about a whole lot but is interesting, if the payments on the loans do not cover the outstanding interest, it's called negative amortization. We'll talk about that in a bit, 3 or 4 more slides. The Secretary of Education, generous guy that he is, will pay the remaining interest on the subsidized loans or the subsidized portion of consolidation loans for up to 3 years. And we have a real calculated example of that as well. Go forward. Negative amortization. Negative sounds bad, and it is. Under all of the federal loan repayment programs, except for income-based and income contingent and pay-as-you-earn, the borrower would pay at least enough on a monthly basis to cover the interest that's accruing on the loans. Under IBR and pay-as-you-earn, that may not be the case. What is he talking about? Round numbers, because I'm a round number kind of guy, $100,000 debt, and that's now below the average law school debt, so put some perspective there. $100,000 at 6.8% a year. If you were financial aid people, I'd ask you to do the calculations. $6,800. So that's the amount of interest that accrues on $100,000 worth of debt. It works out to be about $566 a month. About, because they're paying it down and things like that. At a $40,000 income, payments under IBR are $290 a month. $567 minus $290, $277 a month of interest is accruing but not paid. Whatever portion of that was through a subsidized loan gets paid for the first 3 years by the Department of Education. That's a good thing. If there's no subsidized loan there, that $277 a month is added to the principal of the loan. So at the end of the first month, the principal loan amount is actually $100,000, $100,277. It's capitalized once when the borrower leaves IBR or pay-as-you-earn or no longer has a partial financial hardship, but that starts to add up. And when we talk about this, and then one of the downsides, and there's a slide later for the downsides, if someone doesn't need this, or is looking at it short term or can afford to make interest-only payments, that is a better thing because this starts to get expensive very quickly. If borrowers absolutely need this, they need it and have to take advantage of it. If they're looking at a long-term career in government or public interest and they're looking to loan forgiveness, then they need to get into IBR or pay-as-you-earn. But if not, this gets very expensive very quickly. There is some cancellation outside of the 10-year loan forgiveness. You have to have made enough payments, a $0 calculated payment, so a single person earning less than $17,000 a year who is perhaps unemployed or underemployed or volunteering. A $0 payment is a $0 payment, so for loan cancellation, as opposed to loan forgiveness, that counts. The cancellation of the debt is currently a taxable event under 108F of the Internal Revenue Code, and probably not likely to change. But lots of interesting things are happening with the IRS. For income-based repayment, cancellation occurs after 25 years. If the borrower has been making payments under IBR, ICR, another repayment plan that is more expensive than IBR or pay-as-you-earn. They're making payments under IBR, pay-as-you-earn, or the standard 10-year amortization. If they've made 25 years of those payments and still have a balance, the remainder is forgiven, but it's taxable. For pay-as-you-earn, same concept. If you made payments under 20 years of payments, not 25, under IBR, pay-as-you-earn, ICR, standard 10-year amortization, and still have a balance, the remainder is forgiven. What this has effectively done for especially graduate and professional students who have the Grad Plus loans is turned the standard repayment from a 10-year term into a 20-year term. Borrowers still can pay off their loans in 10 years, and they would have it paid in full. But for many borrowers who can't make those payments and need to turn to the IBR pay-as-you-earn, at the end of 20 years, they will not see full payment on their loans until the end of 20 years. So it's kind of a major cultural shift in the way we're financing education, and it's something people are just starting to be able to digest, just starting to understand. Again, this is not for folks going into public interest, different program, more generous. This is for the nation as a whole. So you could be earning small incomes working in the private sector, be eligible for this, be making your payments on an income basis, pay-as-you-earn or IBR, And at the end of 20 years for pay-as-you-earn, those loans are forgiven, 25 for the income-based repayment. And what happened? So I have to jump into pay-as-you-earn because I just started a job. I don't have a job. I took the first job that was available to me. Now I got a job paying lots more. Now I've become rich and famous. I've won the lottery. Our gang here has been playing Powerball the last few weeks, and unfortunately not winning. But given those fantasies, what happens? So if the borrower is no longer experiencing partial financial hardship, their income is too high, and/or their debt is too low, they can choose to leave income-based repayment or pay-as-you-earn, and then the loans become due at the end of the standard repayment. They have to change repayment plans, things like that. Or even if they're not experiencing partial financial hardship, they can remain in the program, the income-based or pay-as-you-earn program, and have to pay the original 10-year amortized amount. The only catch is because of negative amortization, because of interest accrual, it may take longer than 10 years to repay the loans. So you could be in for 2 or 3 years, making payments under IBR or pay-as-you-earn, get a great and wonderful job, become rich and famous, and still have to make payments for another 13 or 14 or 15 years, bringing repayment up beyond the standard 10 years. So that's something, again, the hope is that the financial aid offices are talking about with students during their exit interviews. This information is available and in something of a user-friendly format from the Department of Education on the studentloans.gov site. Okay, and just an example, kind of putting all those words to numbers. At $40,000 income, you saw a $290 payment under IBR, $200 monthly payment, $100,000 debt. Standard repayment at 6.8% would be $1,155, $1,155. If the borrower spent 4 years of partial financial hardship, making those $290 a month payments, then became rich and famous, they would have paid a whopping $13,000 or $14,000 essentially toward their loans, but would still have $104,000 due. And it would take, at the standard 10-year amortization, it would take an additional 10 years and 9 months to repay. So this is trying to put it into words the understanding of don't enter into this lightly, because it is among the more expensive ways to pay if you don't stay in for the 20 years forgiveness or you're not in public service or public interest. All right, we'll take a break for 10 seconds, actually a break for questions. Anything, I want to make sure you're comfortable with the concepts for income-based repayment and pay-as-you-earn, because we have to understand that in order to move into the understanding of federal loan forgiveness. And it's actually an easy jump. The hard part is IBR and pay-as-you-earn.
There are a couple questions here regarding taxes. I don't know if you caught those on their side screen.
Yeah, I'm not seeing it on my screen. I'm sorry. So please jump in.
Sure. It's the first question, and it's actually kind of two related questions. Do they take into account a spouse's salary when submitting taxes, or is it solely based on the borrower's income?
Oh, good. Excellent question. And I don't have, I try to do the simpler version and not all the financial aid stuff. What is income? What counts? So for a single borrower, adjusted gross income counts. It's the bottom line on the 1040A of the tax form, bottom line on the 1040 form, line 1 on the 1040EZ form. For a married borrower, it gets more complex. And this is, again, federal tax policy definition of marriage as opposed to state definitions and state tax policy definitions. It's a federal definition. If a borrower is married filing jointly, then the borrower and the spouse's income both count. So if you're earning 30, your spouse is earning 50, the calculation is, and you file jointly, the calculation is on $80,000. If you are married filing separately, another category for married taxpayers to file. You may lose some benefits, so consult your tax advisor. I am not giving you tax advice. You may lose some benefits, including some education benefits, the student loan interest deduction, the American Opportunity Scholarship, things like that. If you're married filing separately, then only the spouse who's filing, only their income counts. So if you're earning 30, your spouse is earning 50, and you're married filing separately, your income of $30,000 is the only income that counts. Your spouse, indeed, you could be married filing separately. Your spouse could be earning $1 million a year, and you'd still be eligible as long as you're married filing separately. Sometimes the question will come up, can we amend the prior year forms? Yes. Oh, but on that note, yes, you can, but payments, the only payments that count are payments made after 2009, because that's when the IBR went into effect. So you may run into, again, it becomes more financial aid-y, but we'll run into borrowers who've been working in public service, who made payments prior to 2009. Under this ICR program, that does not count. Any payments prior to 2007 under any repayment plan do not count. Okay, any other questions that I'm not seeing?
There's one here, and you may have kind of addressed it, but this applies to both undergraduate and graduate debt. And this person's asking, did I understand that pay-as-you-earn accommodates consolidated debt, whereas income-based repayment does not?
That is correct. This is weird. The questions are not coming in, for me at least, on a time basis. They seem to be all over the place. So yes, this applies to undergraduate and graduate debt, multiple degrees. Pay-as-you-earn and IBR, both will accommodate, both will include federal loan consolidation, but only on the subsidized loans, the direct unsubsidized loans, and graduate plus loans. Neither IBR nor pay-as-you-earn accommodate the parent plus loans used to finance an undergraduate education. So the plus loans are borrowers, they're borrowing. Those count for both pay-as-you-earn and IBR. They're the grad plus loans, they're called. It's a great, Congress did a great job naming it. It's the graduate parent loan for undergraduate students. They're the grad plus loan. All right, moving right along.
Can we get one more question in, Steve?
Sure. I'm just not seeing it. It's weird. Okay.
Yeah. I don't know why that's happening. But this last question was, are the poverty levels based on national standards or by state standards?
Okay. Great question. So the poverty levels that I quoted, and I should have done this in my disclaimers, the poverty levels that I quoted here are for the 48 contiguous United States. So they are the same for all of the states except Alaska and Hawaii, which have a different poverty level that is slightly higher, I believe, but it's truly slightly. So these are not state-based. They are set by the Department of Health and Human Services every year in December or early January. The inflation on those has been in the 2 to 3% a year range on that. I now figured out how to thread these things the right way, so I will be more useful answering questions. All right, moving into, you just have to click on the column. Moving in then to, cool, Federal Public Service Loan Forgiveness, and we're off. All right, this is not meant for you to read, and again, we'll have the slides. What counts? So this is what the law says. This is everything that the law says. It violates all the rules of PowerPoint, 4 bullets and all that good stuff. Way too much text. What counts are full-time jobs, as defined by the employer, but no less than 30 hours a week. A number we're seeing on the healthcare side as well. Full-time, 30 hours a week or more. Government jobs. at any level, federal, state, local, or tribal. You could be, actually, except Congress. Congress representatives and senators do not count. It's some of this not being subject to the same laws we are. For whatever reason, this does not count. The government, any other government employee counts. Or nonprofit. And again, the news talks about 501c4s we've been hearing a lot about in the past 2 or 3 weeks. 2 weeks, I guess. They do not count. 501c4s do not count. 501c3s count. And 501c3 is what is called a public benefit corporation, and it is not involved in politics or lobbying or anything like that. It is solely for the benefit of the public. What is an example of a 501c3? How about a school? Almost all nonprofit schools are organized under 501c3. Should have asked that question first, but now that I have the attention of people who may be benefiting from the program, it becomes even more interesting and more important. So any 501c3, any government, and all this other stuff. Public library sciences, school-based library sciences that are private, emergency services that are private when no public is available, and all kinds of other good stuff. So if you're interested, go back to the law on that. This are universities. Good. Universities are 501c3. Nonprofit universities, nonprofit colleges are almost always organized under 501c3 in addition to 190A, whatever, of the tax code. So you're probably eligible, worth checking, a quick check with your finance people, but most schools are 501c3s. Great question, and I'm assuming that Tracy is at a divinity school, or maybe not. Ministerial or pastoral work is not eligible, and that is correct. The details, and I should have printed my copy of the law. The details are that work for nonprofit religious organizations, that is proselytizing, that is preaching, that is recruiting, things like that, do not count. I don't know about non-denominational chaplaincy at a nonprofit. I don't know the answer to that. You could be working for an organization like a Lutheran ministry, Lutheran social services, or Catholic charities, and as long as you're not on the religious side, as long as you are doing counseling or serving food or rescue missions and things like that, those are fine, but you can't be, there can't be proselytizing, there can't be a religious side of this. I agree this is a complicated topic. The areas to keep in mind here, and I try to break it down, but obviously I talk too much. I'll pull this together in a summary kind of toward the end. But important on this is federal loans count. There are options. Income-based repayment, pay as you earn. You may be eligible when you get into public service. Government or 501c3 are kind of the obvious areas. If not, you're starting to move into specialty that gets to be a lot more complex. And the resources on this, truly good resources, are at studentloans.gov. Looking into the loan repayment section, looking into there are fact sheets, there are worksheets. The feds have done a good job on this. All right, back to loan forgiveness. The greatest thing since chocolate cake, sliced bread, whatever you can imagine, or maybe not. It is truly amazing. It gives people the opportunity to do public service work, public interest work at low incomes, kind of irregardless of the amount that they borrow. That's a good thing for private schools, law schools and public service schools, education schools, social work. Kind of really gives our students opportunities that they didn't have before, makes us perhaps more, from an admissions point of view, perhaps more competitive With the public school, the state-sponsored schools in terms of tuition, at some level, tuition doesn't matter, costs don't matter because borrowers will be making the same payment. Do not go out recruiting, say, oh, don't worry about anything, you just come to our school, it's great because you don't have to pay your loans back. I've seen that, heard that, that's wrong, it's misleading. Send students out to do their own research. Amazing program, or maybe not. Only federal direct loans. You can consolidate because the consolidation loan is a direct loan now. You can use pay-as-you-earn, income-based repayment, income continuum, 10-year standard amortization, or other repayment plans as long as you're making at least the 10-year amortized payment. This is the key here, 120 months while the borrower is in eligible employment. The eligible employment, remember, full-time, government, 501c3. They need not be consecutive. So borrowers can take a year off, 2 years off. They can go into the private sector. They can perhaps take time off for disability, take time off for other reasons, be unemployed. None of that counts towards the 120 months. You still have to be 120 months where you're employed and making payments. But you can do this up to 200, the first 120 out of 240 months. The forgiveness for these loans is not taxable. Under Section 108F of the Internal Revenue Code, Section 108 deals with forgiveness of loans. Subchapter F says that if it's pursuant to a program designed to encourage public interest, forgiveness of those loans is not taxable. Amazing. But we still have negative amortization because you're making payments under IBR or pay-as-you-earn. You still have the maximum payment, this original 10-year amortized. You may have to pay for more than 10 years if you're not experiencing partial economic hardship or no longer working in the career-wise, have moved out of the public or nonprofit sector. Again, 120 months need not be consecutive, so you can be in the public sector for 3 years, private sector for 2 years, come back another 7 years in government or public interest, and you're subject to that forgiveness. So a good deal there. This slide you've seen before, and a good one just looking at the monthly payments under IBR and pay-as-you-earn. If you borrow more, more is forgiven. One of my fears here, and it seems to be panning out, is people say, oh, yes, I know I'll have this as a career. Let me borrow everything I can so I can live very well while I'm in school, and I know I'll have a government career. And they graduate and decide not to have a government career, or the jobs are not available, or geography plays a role. How clear is the crystal ball? I talk all the time about the crystal ball here because I can't predict the future. Most of our students can't predict the future. We're asking people to look into the future and 10 years into the future. Originally, there was some issue with Peace Corps and AmeriCorps. They now count, so that is not a problem. Record keeping has become easier. Now borrowers, as we were talking about eligible jobs, now borrowers who are employed can go to a website. I just have to look at the website address there, myfedloan.org, and fill out a form and submit it to the Department of Education, and the department will make a ruling as to whether that job is eligible or not. So that's a good thing. I do encourage borrowers or graduates to keep a copy of a 501c3 filing, especially if it's a small company. I'm not worried about Fordham University going under for the next 10 years, or 20 or 50 or 100. But there are nonprofits that are startups that may not always survive. So I encourage the borrowers to get a copy of that 501c3 filing. And again, life can happen. And life does happen. People, as incomes go up and down, all kinds of different things happen to people. And here you're kind of relying for 10 years. So under the 10-year public service loan forgiveness, again, you're making your payments in any one of 4 categories. Income contingent repayment, which we didn't talk about. Income-based repayment, so there you're showing partial financial hardship. Pay-as-you-earn, you're showing partial financial hardship. Or a 10-year standard amortized plan where you do not have to be showing partial financial hardship. Give you an example. It's a med school example. It's the one, until the forgiveness was built into the promissory note, I feared most. Brain surgeon, comes out of med school, does 2 years of residency, then goes into his subspecialty work, and may do that for another 5 years. So for 7 years, he's been working for a public hospital, making payments under IBR or pay-as-you-earn. 7th year is over. He now becomes a fully accredited brain surgeon, board certified, all that good stuff, is still working for the same hospital, same nonprofit hospital. Again, that's the key there. But now is earning $300,000 a year. For the last 3 years, all she has to make is payments on a standard 10-year amortization. So she'll make a total of 120 payments, 84 under IBR or pay-as-you-earn, 3 years worth 36 under the 10-year standard amortization, as long as all of those payments were for while she was working for a nonprofit. That brain surgeon is eligible for loan forgiveness. So in November of 2017, we will see that on the front page of local and national newspapers. Taxpayers bail out brain surgeon to the tune of $300,000, and that's scary. You can, continuing with that theme, you could be a brain surgeon. You could, you could be earning too much to be showing to have partial financial hardship. So then you go in for all 10 years. Then you're making your payments on a standard 10-year amortization. The concept of amortization is at the end of 10 years you have no loans left. So it doesn't matter. You have to have at least some years. This is probably a good calculation. Probably at least 24 months of probably 20, somewhere 20 to 24 months of partial financial hardship in those 120 months in order for this to make sense. Peace Corps, AmeriCorps, as an employee count, I do not believe as a student in answer to that question. There are details on that. So kind of pulling together, if you spend all 120 months in a public service loan forgiveness qualifying job, government, nonprofit, or some of those other categories, life is good. At the end of 120 months, you get your promissory note back from the Department of Education saying X dollars is forgiven. If you need to make the absolute lowest payment on your loans, look to pay as you earn, kind of in a short-term, on a short-term basis, then increase payments as your income allows. I mean, one of the things we've talked about with our students is the ones who need to make the lowest payments, they can, but on a short-term basis, excuse me, to look at paying a little extra every month. There's no prepayment penalty, so that interest is included. Starting to run out of time. I was going to do some examples of real student. Here's a real student. Lots of debt. Monthly payments would interest accruing at $1,500 a month under IBR would be $530. $60,000 income, pay as you earn, $356. Standard 10-year repayment on this would be $3,124, almost equal to the amount of net income. So the borrower would have to make some lower payment, some payment between $356, which would be the lowest under pay as you earn, and kind of the $1,500 interest that's accruing monthly. Again, now we've moved out of the well, and for this person, if they then go into back to eligible employment for 120 months, all of that is forgiven. If they're not into eligible employment and leave at some point in the first 20 years because their income is too high, then they wind up paying some more, or actually much more. Studentaid.ed.gov, finaid.org, studentloans.gov, equaljusticeworks.org, all do nice jobs on this. And again, I will make this available for NAGAP, so this will probably live on your password-protected website as well. What do you think? I'm from New York. I speak quickly. We covered probably 2.5 hours worth of stuff in an hour, but I wanted to get folks exposed to as much of this as possible, and then encourage you to go out and get more information, either using those resources, talking to your financial aid offices, chasing some of this down on your own. This is my contact information. I am available. Send me an email. I will answer what I can. But again, the resources that are out there at studentloans.ed.gov, studentaid.org, studentloans.gov are really good in dealing with this. As to Peace Corps and AmeriCorps, again, I'd send you out to the studentloan.gov. I know that is covered. The whole ministry, proselytizing, recruiting, religious activities is covered in a frequently asked questions on the studentloans.gov site dealing with income-based repayment. Any questions? I don't know if we have a hard cutoff at 2 o'clock and the webinar closes, but if there are questions now, I would be happy to take them.
Well, we can certainly stay on as long as if there are any questions we won't be cut off exactly at 2 o'clock. So if anybody has some remaining questions, and as long as you're available, Steve, we can answer those.
I will answer them. I'll try to answer them. There's a level, as one of the questions pointed out, the level of detail on this is amazing. The first thing we try to get out are the general concepts, so that there's some understanding, but it comes with a caveat. Now go out and do the research on this. The fact that it's built into the promissory note is good. The fact that for public interest, public service loan forgiveness, the Department of Ed will issue a letter ruling that your job is eligible or not are two big benefits that have come into being in the past 6 months or so, that those of us who live close to this get very excited about.
Great. Well, as any other questions are coming in, I just want to, on behalf of NAGAP, thank you for providing this. For all of you that are on the line, you are likely familiar at this point that NAGAP has kind of refocused to focus now on graduate enrollment management, the full life cycle, and financial aid is obviously a critical piece of that. So we're going to be working over the coming months and years to develop educational opportunities to go into greater areas beyond admissions and marketing and recruitment that we've often relied upon, and expanding to all of these different areas. And this is our first really primary foray into that, and we really appreciate the information. So, and with that, there is a question here regarding public service loan forgiveness.
Okay, and taxability. Right, so public forgiveness, 10-year, 120-month, public service loan forgiveness is not a taxable event. Under Section F, paragraph F of Section 108, it says that loans forgiven pursuant to a program to encourage public service, that forgiveness is not a taxable event. For IBR, forgiveness or the discharge of the indebtedness happens at the end of 25 years if the borrower has made payments all along and the payments have not covered the loan. For pay-as-you-earn, it's 20 years. The discharge of that indebtedness under the IBR and pay-as-you-earn is a taxable event. So it is possible that in year 20, a borrower may have taxes due on 50 or 60 or 70 or $100,000 worth of debt. I have no idea how the IRS is going to deal with that at that point. There's been a movement since 2009 when IBR was built in, and actually since the early 2000s under the ICR program, to get Congress to change the law on the forgiveness, on the taxation of that forgiveness, but it has not had any legs. It's died in committee just about every time. I don't think it has made it to a full vote of Congress yet. So the assumption has to be under IBR and pay-as-you-earn, if you're in for the 20 or 25 years, that is taxable. If you're in for the 10 years and have forgiveness pursuant to the Public Service Loan Forgiveness Program, then that is taxable. Cool, that looks like it in terms of what I'm seeing now that I figured out how to order these questions the right way. I will encourage those of you there's still a bunch of you hanging on, so this is good. I've now been doing webinars for a few years. If you're thinking of doing conference presentations, and if you have things to contribute to the community at large, whether it's your students, we do lots of webinars for our students, whether it's NAGAP in general, whether it's to your local graduate and GAPs, get involved. Webinars are a lot of fun. The only downside is I don't get to see your faces. You don't get to see mine. That's a good thing. But I don't. It's hard to judge reactions from people. But if you have that opportunity for professional development, get involved. Do a webinar. We do a lot for our graduating students and our recent grads. We did a whole series when Pay As You Earn came out. We started in January, though. We didn't do anything while we were closed between Christmas and New Year's.
Well, thanks, Steve, so much. We really appreciate all your information. And for everybody that's on the line, we will be sending you a survey. So I think that's a great way, in absence of not being able to see your reactions, at least get some feedback from you as you kind of digest all this material and think about what you learned today. Please fill that out and let us know. And Steve, I'll be happy to share that feedback with you so that we can make sure we improve upon all of our webinar opportunities going forward and find out how receptive you are to different types of topics like these that go outside of our normal realm for NAGAP.
Yeah, and don't just answer the questions so NAGAP can give a number as to the quality, but take advantage of the free text opportunity to say exactly what you want. That's most useful to presenters and to NAGAP.
For sure. All right, thanks so much, Steve, and thanks everybody for joining us today. And we'll be having our next set of webinars in the next couple of weeks, so be sure to watch your email. So thanks so much, and have a great afternoon.